Hey everyone, welcome back. Today we are breaking down three ways people trade the market: intraday, swing, and positional. By the end of this video, you will know exactly how they work, what they really pay, and which one actually fits your life. Let's get into it. Here's what we are covering today. First, we are going to understand what intraday trading really is and why so many experienced traders stay away from it. Then we'll look at swing trading and positional trading. After that, we'll compare the actual numbers side by side, dig into how each style works, and finally talk about the real risk versus the real reward. Before we start, quick disclaimer: I am not a SEBI registered advisor and nothing in this video is investment advice. Please remember, investing in the market always comes with risk. This video is purely for education purposes only. Let's start with intraday trading. Buying and selling a stock within the same trading day sounds simple, right? Let's see what actually happens when you try it. Here's a real 15-minute chart of the Sensex over two trading weeks. I have plotted opportunities onto the chart. There were some uptrending days, there were some downtrending days, and there are many range bound days. Out of 14 trading days, only 8 were actually trending, meaning they had a clear enough move to even trade. And even on those good days, the average return was just 0.4%. That's the opportunity, and how much of these would somebody cash in is also a question. Demands your full attention every single day. Now let's look at the real cost behind those numbers. 14 days means 14 days of full time screen time. Only 8 were trending, so the other 6 could easily mean losses. You are also competing against high frequency algorithms that react in milliseconds, something no human can beat consistently. And after leveraging and taxes, that 0.4% return shrinks to just 0.28%. This is due to intraday being taxed as business income, which is, by the way, the highest slab in this country. This is exactly why more than 70% of people who try intraday trading end up losing money. Here's something called the accuracy paradox. Let me ask you, which of these three predictions is most likely to come true? First one, it will rain on 8th July at exactly 2:15 pm. Second one, it will rain sometime in the second week of July. Or third one, it will rain on some day in July. Obviously, the third one has the best odds because it's the widest guess. Intraday trading is like betting on option 1 every single day. You are asking yourself to be right about the narrowest possible window again and again. That's why it's so hard to do consistently, even for experienced traders. Alright, intraday is out of the way. Please take some time to like my content, share, and subscribe to the channel. Now, let's talk about two styles that give your trades room to breathe: swing and positional trading. Look at this 3-year chart of the Sensex, and I have marked swing opportunities with the arrows. Instead of chasing every 15-minute move, swing trading zooms out to catch the bigger structural swings, and there were 6 clear ones here. Each trade lasted about 1 to 2 months with returns ranging from 6 to 10%, averaging around 8%. Fewer decisions, wider stops, and time to actually think before you act. Now let's zoom out even further. On this same chart, there was one major long term trend, and if you had simply held it for 2.5 years, you would have captured a 30% return. That's it, one trade, one trend, one exit. This is how low stress as trading can get. Let's put swing and positional side by side. Swing trading gave you 6 trades over 1 to 2 months each, averaging 8% return per trade, adding up to 48% total uncompounded. Positional trading gave you just one trade over 2.5 years for a 30% return. But here's the interesting part. After tax, swing trading nets you 38% while positional trading nets 26.25% because positional gains qualify for the lower long term capital gains taxes. Learning and adding swing trading to your investment strategy can definitely improve your returns with reasonable effort and time commitment. However, you should not miss out on positional trades which can be taken on indices using ETFs. For further information about the ETFs, I have made a video which you can check out in the link above. So, how do you actually spot these trades? Swing traders usually work on 4-hour and daily charts, sometimes weekly. They rely on tools like moving average crossovers, fib retracement levels, and support resistance bounces. Positional traders zoom out even further, daily, weekly, even monthly charts, and they focus more on the bigger picture, corporate earnings, industry growth trends, and sector rotation. Every style comes with a trade off. Swing trading uses wider stops, takes time to master, and offers moderate targets with faster compounding. Some people also use leverage using MTF facility, but it's taxed as short term capital gains. Positional trading needs deep stops because you will sit through bigger pullbacks and drawdowns. It offers the maximum upside potential, needs little to no leverage, and enjoys the friendlier long term capital gains tax environment. Let's talk about real life. Swing trading needs minimal but regular screen time, comes with moderate stress, and works well if you want a side income alongside your main job. Positional trading only needs periodic check ins, brings low stress, and honestly, it's perfect for working professionals who don't have time to watch charts all day. So, if you are an investment enthusiast, learning swing trading is worth the effort than high risk F&O and intraday trading. And that's a wrap. We went from why intraday is a tough game to win to how swing and positional trading can actually work in your favor. If this helped you understand the difference better, hit like, share it with a friend who's curious about trading, and subscribe for more content like this. Thank you so much for watching. See you in the next one.